In this video, I'm going to show you one of the best strategies that any beginner trader can use. So the strategy contains of two indicators and a candlestick pattern. So the two indicators that you are going to use for this strategy is the 21 EMA and the 50 period EMA. So the 21 EMA and the 50 period EMA is going to help us filter a strong trend which is going either up or down, and then the candlestick pattern is going to give us the entry point of the trade, right? So what happens is the 21 EMA reacts faster than the 50 period EMA, right? Simply because it takes 21 candles to calculate the 21 EMA, and it takes 50 candles to calculate the 50 EMA. So the rule here is simple. If you see the 21 EMA above the 50, which is the blue line above the red line here, you are going to see that the market is in a strong uptrend, right? So if the market is in a strong uptrend, what do you want to do? We want to be buying and following the trend, right? So when do we buy exactly? We want to see the market moving into the zone between these two moving averages here, and then once the market moved into this zone here and closed above the moving average, you are going to enter the buy position immediately. So let me show you, let me zoom this out. So from this here, you can see that the moving average crossed right here, showing us that we are going into an uptrend momentum, right? So how do we trade this? We simply look for the market to trade above this moving averages, and we want to see gap between the 21 EMA and the 50 EMA, and then we want to wait until the price pulls back into this zone here and closes above the 21 EMA again, which is right at this point here. So if we were trading this, we were going to buy at this point, and we put a stop loss below the lowest reversal point of that market, right? So from there, you can see that we could have placed a trade right here. And then what happens next is you see the market moving up again, pulling back into the zone between these two EMA. And most importantly, there is gap between these two EMA. If there is no gap between these two EMA, you don't want to be placing that trade, right? So we see the market pulling back into this zone here, and after the market pulls back into this zone, what happens next? The market moved up here and closed above this zone here. So if we were trading here, you were going to buy at this point here, and you put your stop loss down below and expect prices to go up, right? So for the take profits and stop losses, you can do 1 to 1, 1 to 1.5, or even 1 to 3 risk to reward, right? And I want to tell you that this strategy can be very, very profitable, since once in a while, if the indicator really crosses, if these indicators really crosses and start moving with a gap between, in synthetic indices especially, it's going to take a little bit of time moving above that moving average. So you can really ride this trend until as much as you can. Now let's look at another example. We see the market pulling up, another pullback, right? And then from here, what do we see? We see the market closing above the 21 EMA, and what do we do here? We simply buy at this point here, and we put our stop loss below this level here. And in this case here, you could have just got stopped out with this small weak candle here. But this is the reality of trading, right? We are not going to win always. You are going to lose some trades and win some trades. That's why we always talk about huge risk to reward ratio, right? And now after that, you can see that again the market pulls back, right? So this is continuing to happen over and over again. So you could have bought here. So because the market traded above, pulls back into this zone but didn't close below the 21 the 50 period EMA, right? So we're going to buy here, put our stop loss right here, and then we see the market moving back up. So let me show you the bearish examples of that, right? You can see that all this time here you could have placed winning trades all this time here, right? And then the market closed to the downside, right? After a while, the market really shifted momentum from trading above the moving averages to trading below the moving averages, right? So now what do we do here? We are waiting for the market to trade below the moving averages and then pulls back to the zone between the moving averages. So for example, the market was trading here, pulls back into this zone here, and really didn't close above this 50 EMA. But what happens next is the market moved down below the 21 EMA. So what do you do here? You sell right here. You sell and you put your stop loss above this highest point of reversal, and then you put your take profits down below, right? And it happens again and again and again. You can see here you could have placed another trade. You see the market moving down, pulling back into that zone, but not closing below this, and then the market pulls back down and closes below. So you could have placed another sell order here, your stop loss, and then you take profits down below. And this continues happening again and again and again and again. So this is where you could have been placing all your trades. Right now you can see that the market shifted above here again, pulls back into that zone but didn't close below the 50, and now closed above. And then you could have placed a buy order right here. You place your stop loss below the lowest point of reversal, and then you take profits based on your risk to reward ratio. So this is a very simple strategy that I found to be working very, very well with volatility indices, especially volatility 10 and volatility 75, right? So this continue happening again and again and again in this market, right? So one of the things that you want to avoid when trading this indicator is this strategy. When trading this strategy is avoid to trade when the market is not in a clear direction, like here. As you can see here, the moving average, right? The moving averages have no gap between them. So you want to avoid these points here, like this point here. You want to avoid again this points here. You only want to trade when you start to see gap between the two moving average, this moving average and this moving average. You want to see gap between them. That's where you want to place your trade, right? So if you see with the points where the market is in a choppy or range market like this, you are not going to be placing a trade. Thank you for watching this video. If you are new to this channel, make sure you click that subscribe button, and if you are a returning viewer, I really appreciate you, and I'm gonna see you in the next video.